If you sold any stocks, crypto, or real estate this year, the IRS wants their cut. But here's the thing. You could be paying way more in taxes than you need to. The next 10 minutes, I'm going to break down everything you need to know about capital gains taxes, show you the exact rates for 2024 and 2025, give you 6 proven strategies to legally reduce what you owe. What's up, everyone? Before we dive in, if you're serious about building wealth and keeping more of your money, make sure to subscribe and hit that notification bell. We're covering the stuff your financial advisor should be telling you, but probably isn't. All right? Let's start with the basics. Capital gains are simply the profit you make when you sell an asset for more than you paid for it. Think about it this way. You buy a stock for $1,000, sell it for $1,500. That $500 profit, that's your capital gain. Let's buy a house for $300,000. Sell it for $400,000. That $100,000 is your capital gain. But here's where it gets interesting. The IRS doesn't just look at your gains. They also look at your losses. So if you made $10,000 on one stock but lost $4,000 on another, your net capital gain is only $6,000. This is crucial for tax planning, which we'll get to later. Now not. Everything counts as a capital asset, but most things do. Stocks, bonds, crypto, real estate, even collectibles like art or coins. Your car, your boat, even your baseball card collection, if you sell it for a profit. The IRS wants to know about it. Here's where the government either becomes your friend or your enemy. It all comes down to one thing: time. If you hold an asset for 1 year or less before selling, that's a short-term capital gain. The government treats this exactly like your regular income, so you're paying your normal tax rate, which could be anywhere from 10% to 37%. But if you hold that same asset for more than a year, just 1 day more, it becomes a long-term capital gain. And this is where the magic happens. Long-term capital gains get special treatment with rates of 0%, 15%, or 20%. Let me give you a real example. Say you're in the 24% tax bracket and you make a $10,000 profit on a stock. If you held it for 11 months, you pay $2,400 in taxes. But if you held it for 13 months, you might only pay $1,500. That's $900 saved. It's just for waiting 2 extra months. Let's get into the actual numbers you need to know. For long-term capital gains in 2024, if you're single and your taxable income is under $47,025, you pay 0% on long-term capital gains. That's right, 0. From $47,026 to $518,900, you pay 15%, and only if you're making over $518,900 do you hit that 20% rate. For married couples filing jointly, these numbers basically double. You get the 0% rate up to $94,050, then 15% up to $583,750. Now for 2025. These numbers get adjusted slightly for inflation. The 0% bracket for singles goes up to $48,350, and the 15% bracket goes up to $533,400. The key takeaway? Most people. And I mean most people are paying either 0% or 15% on long-term capital gains. The 20% rate only kicks in at really high income levels. But wait. There are some curveballs you need to know about. First, if you're a high earner, there's an additional 3.8% net investment income tax that can apply. This kicks in at $200,000 for singles and $250,000 for married couples. Second, collectibles like art coins or precious metals get hit with a maximum 28% rate on long-term gains. Not the nice 0%, 15%. 20% rates, and here's something important. If your investments are in retirement accounts like 401ks or IRAs, you don't pay capital gains taxes while the money stays in the account, but you will pay regular income tax rates when you withdraw in retirement, unless it's a Roth account. Now, for the good stuff, how to legally pay less. Here are 6 strategies every investor should know. Strategy number 1. Just hold longer. This is the easiest one. If you're getting close to the 1-year mark on an investment that's up, Seriously consider holding for just a bit longer to get those preferential long-term rates. Strategy number 2. Max out tax. Advantaged accounts, 401ks, IRAs, HSAs, 529 plans. These are your best friends. Money grows tax-free or tax-deferred in these accounts. If you're not maxing these out before investing in taxable accounts, you're doing it wrong. Strategy number 3. Rebalance with dividends. Instead of selling winners to buy losers when rebalancing, use your dividend payments to buy more of your underperforming investments. You avoid triggering capital gains while still maintaining your target allocation. Strategy number 4. The home sale exclusion. This is huge. If you sell your primary residence, you can exclude up to $250,000 in gains if you're single or $500,000 if you're married. You just need to have lived in the home for 2 of the last 5 years. Strategy number 5. Tax loss harvesting. This is where you strategically sell investments at a loss to offset your gains. You can offset gains dollar for dollar, and if you have excess losses, you can use up to $3,000 per year to offset regular income. Strategy number 6. Consider a robo-advisor. Many robo-advisors automatically do tax loss harvesting for you. It's like having a tax strategy running in the background without you having to think about it. Look, taxes are complicated, but capital gains taxes don't have to destroy your returns if you plan properly. The difference between short-term and long-term rates alone can save you thousands. If this helped you understand capital gains taxes better, smash that like button. And if you want more content on building wealth and keeping more of your money, subscribe and hit the notification bell. Drop a comment below. What's your biggest question about capital gains taxes? I read every single comment, and your questions help me make better content for everyone. Remember, I'm not a tax professional, so always consult with a qualified tax advisor for your specific situation. But understanding these basics puts you way ahead of most investors. Thanks for watching. And I'll see you in the next video where we're diving into the biggest tax mistakes investors make and how to avoid them. Peace.